fast this year's gone. I don't know if it's gone so fast because I've just been uh, quarantined or if it always goes this fast. I don't know. It's crazy. Anyway, it's the 12th of May already. So almost halfway through the year. Gonna do a quick update for you. We're gonna run through what's happening over in the Forex markets. We'll have a look at what's happening here in futures and in crypto. And we'll talk about a trading method that's a combination of the bounce and the breakout. So 2 weeks ago, we talked about breakout trading, which again, I feel like is a great way to trade. It's a super easy, simple setup. It's easy to follow psychologically because you've got confirmation of a move when something happens. And it's effective. It gives you an edge over the long term, and that's all we're really looking for, is that edge over the long term. Now, with that said, and I'm going to get off on a little soapbox here, oftentimes, in fact, more often than not, people, traders, aspiring traders, experienced traders, whatever, seem to confuse an edge with some sort of a certainty. An edge isn't certainty. An edge just means you have a slight opportunity to have something go in your favor than it does to not. It's a slight. An edge is just a tiny bit. For comparison's sake, casinos, right? We odds and probabilities is what it comes down to. Casinos have a tiny edge. Roulette, for example, the casino edge is 2.7%. That's the edge, 2.7%. So don't confuse your edge with certainty. Just because you have an edge doesn't mean you're going to win every trade. It doesn't mean you're going to win the majority of your trades. You've got to combine the edge with money management, and that together provides you with that opportunity for long-term success. Long-term success is exactly that. You've got to look at a good sample size in order to understand what your success rate could potentially be. I know I say this all the time. It doesn't seem to get through to people. I don't know why. Maybe I'm saying it wrong. Maybe when I start to say it, I switch into some language that people don't understand. I don't know. I don't understand why you don't understand that a freaking edge doesn't mean you're going to win every trade. It's just, it gives you a slight advantage over the long term. Okay, so with that said, just more frustration. I'm frustrated because I got an email today from somebody that was saying that, such and such a program didn't give them the edge that they thought they were going to get. What did you think you were going to get? An edge is an edge. An edge doesn't mean you're going to win all the trades. An edge just means you give yourself a slight advantage when you work the process the same way over and over and over. It gives you that slight edge over time to have winners that are greater than losers. Couple that with good money management, it gives you the opportunity to grow your account. Most people stop because they hit a series of losses. And no matter what you're doing, you're going to have a series of losses. Even if you flip a coin, you're going to have a series of losses. People give up because they get a series of losses and they think their edge doesn't work anymore. Well, what happened was you stopped working the edge. You stopped putting in the work. So obviously it stopped, right? So anyway, let's go ahead and get to something more positive. I'm going to continue on here. We're going to talk about the things that are happening and how it's working in the marketplace. I do want to get to the bounce and breakout combo because I really like that strategy. It's kind of the best of both worlds. You've got things pulling back, but you're still, but at the same time, you've got a bias that's going in another direction for you. We're able to look at a combination of that pullback and a breakout, giving us an opportunity for continued movement. So we're going to get to that today because I really like that trading strategy, almost as much as I really like just a breakout strategy. I like them both. Last week we talked about bounces, which again, very effective strategy. You've got to have a little bit more of a contrarian mindset, I think, because you've got to be able to buy or sell into the face of a movement, of a momentum move that's opposite of what the overall trend is. But again, still very effective. Really, any trading strategy is effective as long as you effectively manage it, right? I think that's the point of everything that I talk about on a daily basis. So what's going on today? There's some news coming up here in about 15 minutes. We've got the Consumer Price Index reports coming out. The core CPI is probably the biggest deal here. This one's being released in, like I said, 15 minutes from now. This will be coming out. That could potentially be a catalyst in the marketplace. It's definitely high impact news, and we'll see, when the regular trading session begins, how that is interpreted and what effect that might have on the overall markets. We'll see. Certainly in trading Forex, that could be something that would catch our attention, because usually around, again, not always, but usually around high impact news events, we have spreads widening considerably as orders come off, and we're waiting to see what happens with that news. And market makers pull their orders off the books, which widens spreads, because you have the bid and the ask. There's nothing in between there. Spreads will widen, and it's usually just for a few seconds, right? But then following that, as orders flow back in, based on the outcome of that report, we can see some chop and some whip in the market. So just be careful of that. No matter what instrument you're trading, if you're trading in, or what market you're trading, if you're trading in Forex or you're trading in futures, we could potentially see some activity around this. The futures activity really may not be seen, though, until we get into regular trading hours and we get the market fully underway there. What's happening over in Forex land? Well, honestly, I haven't even looked this morning yet. I've been doing some reading this morning, trying to catch up. I didn't get my reading time in yesterday, so I had about an hour this morning that I was trying to catch up on a book. I'm starting to read this book called Atomic Habits. I'm just gonna grab it for you. Started to read this one over here, Atomic Habits. So good so far. It's certainly something that we really need to focus on. I mean, it's everything we talk about here in trading comes down to consistency. It's a habit. We need to form habits in order to be consistent in the market. We have to have a consistent process and a consistent application. So, I'm always working on mindset. We're always working on ways to improve our mindset so that we can stick to things, because everything else is math. I know it's kind of overused, but trading is easy. It really is. And I say that tongue in cheek, because it's not, right? But the act of trading is really comes down to a set of quantifiable things happening. You've got quantifiable information. You've got indicators showing you things that are quantifiable, and as all these quantifiable things occur, we should take an action. I use the word should because that's where the mindset comes in. We often don't, because the mindset gets in the way, or the habit isn't there. We haven't ingrained that in ourselves, and we don't do it, and that's where we fail. That's my biggest downfall. When I don't follow the plan, I fail, and I think that's everyone's downfall at the root of it. If you really look back and are honest with yourself about how your trading is going, it's because you're not doing the plan. You're not following the plan. So anyway, I'm getting off on tangents here. So I just started looking at the market this morning. What's going on? Obviously we can see the USD and the Aussie are on polar opposite sides over here. Aussie USD is the pair. It's already moved 103 pips. Averages into the 90 range. So, does that have, quote, gas in the tank to continue pushing longer? I mean, it certainly could. But what's the likelihood of it? I mean, it's already moved past its typical range. Although we do see the USD continuing to weaken here, the Aussie isn't looking great as that counter currency. But the Aussie, New Zealand are the strongest currencies in relation to the others as we're coming into the new session here. We are seeing some divergence between the Euro and the USD. USD weakening against that Euro. Now with news, though, coming up in another 10 minutes, that could certainly change. We don't know what that news is going to bring. So for Forex, I'm going to sit on the sidelines here because I don't want to take a new trade, 10 minutes ahead of news. We could go flat coming into high impact news and not do anything. So I'd rather wait until the news occurs and then come back into the market, see what our currency strength indicator is looking like here, and see where we might potentially have opportunity post news. With news coming up, it doesn't seem like a great plan to jump into it, because we could be in this short the USD, CPI comes out, and suddenly we see the USD rally, and that'll change everything. And knowing that we have that potential market catalyst, I feel like it's better to wait until that's done and take action after that. So with that said, let's move over here to the futures market. What's going on in the futures market? Well, continuing to rally, kind of across, in S&P is continuing to push longer, as is oil. Oil's really seen a nice rally over, really since last 2 weeks now. Oil's seen one heck of a rally off of that. And gold, though, is kind of just hanging. Gold has hit a bit of a channel over here, between this, really in the 1700 to 1720, and it's been a little higher, a little lower, but it's just kind of sitting in this channel right now. So gold isn't doing too much. As far as biases go, we've got a long bias on the 4-hour on the S&P, and we have a long bias on the 30-minute. Same here in crude, we have a long bias on the 4-hour, and when we switch over to a 30-minute, we can see that's a long bias as well on the 30-minute. So those two, both of these are in agreement. So the 30-minute bias is in agreement with the 4-hour bias on both of these. Gold, however, 4-hour bias is down, 30-minute bias is long. So gold is a little mixed right now. It was mixed yesterday as well. So as far as gold goes, I don't think I'll be doing much over here. But the other two, if we've got the bias is in line with what we would be watching for, then that's certainly a viable trading opportunity. So the bias is long. So what does that mean to us? Well, if we've got a long bias on something, it means we'd be looking for long trades until that bias changes, right? We'd be looking for long trades, and there's multiple ways to look for long trades. We can either look for a breakout, so this 29.35, 29.40 area, which was yesterday's top, is kind of setting up as a potential resistance point up here. So we could certainly, as the regular trading hours begin, an hour from now, we could certainly look and see where price is. Excuse me, and we could utilize, the top as a potential point to buy on a break of that top area. So 29.35 could be that break of that top area up here. As far as pullbacks, we could be looking a little lower, looking down here at 29.20 as a potential pullback area. We can see how that was respected yesterday. It was respected even the previous day as we broke through that level, came back to retest it, and moved on. Yesterday, we see that as a retest. It was kind of an area price struggled around 29.20 just a bit yesterday. So, we could look for pullbacks, 29.25, 29.20. Or we could use a combination of a pullback and breakout. And basically what that is, if you're looking at an uptrend, so let's say you have a long bias, and let's just make this a little bit bigger. The way that would work would be if you've got a long bias. So for instance, yesterday, right? So this is yesterday over here where my cursor is. So from this vertical line to this vertical line, that's the Monday trading period. Now the live trading session, the regular trading hours began, right about here. Well, really here. They began here and went, over to here. So that's your regular trading session right in here. And this is, by the way, my time period. So it's displayed in Central Time. So, but anyway, so what would we be looking at if we're looking for a bounce and a breakout? Well, if we're looking at a long bias, and just assuming we know it was, but the 30-minute was in agreement with the 4-hour. If we're looking for a long bias, what we'd be watching for is as price is pulling back, we would be setting our entry at the top of that newly closed candle, right? So, price moves off, so we're looking for price to pull back. So we're looking for lower highs and lower lows. So lower highs and lower lows in an upward trend. So we're in an upward trend, 4-hour bias, 30-minute bias, both moving long. We're looking for lower highs, lower lows. So we had Price had hit here, then it started to pull back. The next candle, we had a lower high and a lower low from the previous. So as this candle closed, we would put our entry point right up here. Okay, didn't happen. Move down, new candle, this one closed. So now we're beginning of this candle, we've got a entry point here. Nope. Entry point here. Nope. Entry point here, entry point here. So we're trailing it down. Finally, we get out. Well, I'm moving my chart as I'm doing that. So finally, we get down here. So this candle closes. We put our entry point. This candle, as it closes, we would put our entry point here with a stop loss at the bottom of that previous candle, or slightly below maybe the bottom of that previous candle. So in this case, price broke above it. Finally, it broke through. So we're looking for that bounce. So we're looking to go long. We're not really looking for a specific area. We're just looking for it to pull back. And as it's pulling back, we're trailing our potential entry point down at the top of that previous candle that had the lower high and lower low. And we're continuing to pull back, pull back, pull back. Finally, we've got it parked here, and on that next candle it broke out, and we can see it moved on. So that's basically the process. So for today, today for example, as the off trading hours have been trading here on the ES, this is a 30-minute, we've been pushing higher. So now our bias is long, and it agrees with that 4-hour bias that's also long. So what we would start doing now is waiting to see if we get a pullback. So we'd be looking for an opportunity to enter long by watching the market, and if the market pulls back, so we get a lower high and a lower low, we would just start trailing our entry, our potential entry, at the top of that candle that had just closed with the lower high, and put our stop loss at that lower low. If it breaks through there, then we're into a trade. If it doesn't, then we just ratchet it down on the next candle, the next candle, the next candle, and so on and so forth. And that's all there is to it. It's super, super easy. Now, with that said, you will not win every trade. Okay? It gives you a slight edge, just like any other trading method does. You will not win every trade. As a matter of fact, let's just have a look at this. If we had done this on let's say a 5-minute yesterday, well, I can probably find some examples of where this didn't work anyway. And there's always going to be examples of how it doesn't work. This is where the back testing comes in. I mean, if you're looking at potentially utilizing a new trading method, go through and back test it. I highly encourage you to back test anything, and the reason for doing that is so that you can figure out what's working and what's not. Our brains typically have a bias based on our belief systems. So whenever we look at something, we see more of what we believe to be true, right? So if we're out here, it's kind of that adage of, if you start thinking about buying a Jeep, you're going to see Jeeps everywhere, right? Because your brain's focused on that. If you think that, I don't know, let's see, if you wholly believe that Ichimoku Cloud, is predictive, and every time it hits the top or the bottom edge of that cloud system that price is going to reverse, your brain is going to see every time that happens, every time it goes to the edge of that cloud system and it reverses. You're going to see that every time. It'll filter out all the times it didn't work. So just like this, we talked about yesterday, this trading process that I just talked about would have worked beautifully yesterday. Now, if we go back, there are going to be times that didn't work. Here right away I can find one. It took me a second. Right away here. So, we're in an upward trend. Price pulled back. Made a lower high, lower low. Would have broken. Well, I guess it never came back to touch it out. Darn it. I need one where it made that lower high and lower low, and then stopped you out. They're back here. There's going to be you'll find the losing trades. You got to go. You'll find the losing trades because no system is ever perfect. There's absolutely no system that's perfect. The challenge is our bias will filter for us, and we'll find all the times that it works. So, whenever you're backtesting something, it's really important to go through and backtest it. And you do that cursory kind of just really quick backtest where you look and you say, okay, yeah, there it worked, and that's great. But then when you find a whole bunch that worked, it's really important to reset your brain and go look for all the times that it didn't work. That way you can get a super clear idea of hey, it doesn't work every time. I need to set my expectation for that. And then you can go back and you can backtest really, really carefully and drill down on different time frames to see when is this doing what it's supposed to do, when is it not doing what it's supposed to do. But ultimately, it's that combination trade. So we figure out our bias on whatever time frame that might be, and however you're doing that. I've talked about finding the bias based on looking at a 4-hour and using moving average cross to identify what my directional bias is just by moving averages, right? It's quantifiable. We can look at a chart and go, that's in an upward trend. But then you've got those red pieces on any time frame that start to come in. At what point do you say now that trend has changed? Is it 2 red bars? Is it 3 red bars? Is it 5 red bars? What is it? What's your definition of the bias? So for me, moving averages are a great way to quantifiably look at what the bias is going to be. So I look at that on a 4-hour, and then I measure that on a 30-minute. I say, hey, if my 4-hour and my 30-minute bias are the same, I want to look at trades in that direction. If they're mixed, don't do anything with it. That's super easy, right? Then we can go and we can apply that next trading step. So we've identified bias, we've identified the time frame we're going to trade on. Then we start looking at what are we going to do? We're going to do a breakout, we're going to do a bounce. Are we going to do a combination of a breakout and bounce? The combo strategy is what we just talked about, which is if we're looking at a long bias, so again, yesterday, long bias, we're waiting for price to pull back, finding lower highs and lower lows, lower highs, lower lows, trailing that potential entry point down. And then when it breaks through, I've got my entry point and my stop loss. Now, how do you manage that? Well, there's a couple of ways we can go. We can manage that by either looking at a win ratio, our risk to reward ratio. So, we could look at setting a profit point of 2-to-1 or 3-to-1 on that trade. So if it moves, and we don't move our stop, we keep our stop where it is. It's a static, whatever X number of points of risk. And if it moves, 2 times that, we take profit. Or if it moves 3 times that, we take profit. What's the perfect point? Is it 2 or 3? Which is it, Brian? Tell me. Is it 2 or 3? I don't know. That's up to you. You've got to figure out what works best for you, because if you set it at 3, there's going to be a number of times when it might go 2.5 into profit and then reverse back and take you out for a stop loss and didn't quite get to 3. If you set it at 2, there's going to be all the times that it hits 2 and then it continues on and it might have gotten 3. Which one works best for your psyche? You've got to understand your personal triggers. Because if you set it one way and then you start deviating from that, you're not going to have consistent results. So what is it? I can't tell you that. You have to do the homework. You have to put in the effort to go back and actually back test it, see how often it wins, how often it loses. And that's actually kind of a way to figure it out too. If you're looking at some actual back tested numbers, you can figure out which one works best to give you that best potential return. Is it at 2-to-1 or is it 3-to-1? You might win more at 2-to-1. You might have a better win-loss ratio at 2-to-1. So that might smooth out the equity curve a bit, but maybe your growth isn't as rapid. When you use 3-to-1, maybe you have more losses, but when you have those gains, they're bigger, and so you have this kind of stair-stepped equity growth, but maybe you end up with better equity growth. It depends on what you're after. Does your subconscious want to see more wins, or does it want to see better equity? It just depends. You've got to figure that. I can't answer that for you. No one can answer that for you. I mean, people can tell you, they can give you their opinion, but if it's not your answer, you're never going to stick to it. And that's what it all comes down to with this. And if you've listened to me for any length of time, that's what I keep trying to repeat over and over and over and over and over and over. You've got to do the homework to figure out what works best for you. I can give you some ideas of how to trade and some methods that are very effective, but these methods are only effective if you actually do them and you stick to them. You got to stick to the plan. It's a slight edge. Again, coming back to the casinos, 2.7%. That's the edge on roulette in a casino. It doesn't take much of an edge to be profitable, but it only works out over the long term. The casinos are paying out more. They're paying out hand after hand after hand after hand. They're only winning. They're only taking the wins a small percentage of the time. Their edge is just slightly better than break even, just barely better than break even. We don't need this crazy edge, to be profitable in trading. And the sooner you understand that, and the sooner you put good practice into actual work here, the sooner you're going to be on that path of profitability. So anyway, that's it for now. I think that gives you a good understanding of how we would do this trading method. Super basic, super easy. The other way, by the way, to manage it is to ratchet your stop loss at the bottom of that previously closed candle. Now again, you're going to take off risk, but you're also going to have periods where you may not ever hit your targets, or maybe you don't even use targets. Maybe you always just ratchet. So sometimes you might have a 1% win, sometimes you might have a 6% win, sometimes you might have a 0.2% win. So the other way to manage it is to not use a target and just manage by trailing your stop at the bottom of that previous candle the whole way up. And again, you've got to figure out what works best for you, because sometimes when you do that, price will move up, then you'll get that where it comes right to your stop loss and then moves on without you. You've got to be comfortable with that. So there is no method that's just 100% magical. It's what works best for you. And the only way to know that is to put in the effort to actually do the back testing and do the homework. It doesn't take a lot of time. You can do it over the weekend, but put in the time to do it. And that'll help you get on your start. And then from there, just be consistent. Some great books, Atomic Habits. I mentioned Power of Now, another good book to read. A lot of good books. There's a lot of Trading in the Zone. There's tons of good trading books out there that work on the trading mindset, because that's the biggest challenge most traders run into. We can all have these great systems, and there's easy to follow systems, and the systems will give you a positive edge if you work the method. All right, so that's it. What's happening in? I didn't even talk. Did I talk about the others? No, I just got off over here. So let's talk about the rest of this. So looking at areas to trade. So we talked about breakout on the ES over here. So on the S&P, we'll see when regular trading hours begin where we are. But certainly, looking at a break of this top up here could be a nice breakout trade if we get some positive movement as the regular trading hours begin. Pullbacks, looking back here to 29.20 area. Of course, we'll see what occurs. We have to always take the new market session into account, and also be watching whatever our quantitative indicator is that's going to tell us the directionality. If the direction changes, if let's say this flips and we have a big downward movement at some point, then we don't want to keep looking at longs any longer if the market condition has changed. So we need to keep our eye on the market condition as well in order to understand which direction that we're trading. But for right now, based on the limited data we have leading up to the new session, breakouts above 29.30, pullbacks to this 29.20, even 29.15 area could be good for us if we're looking for long positions. The flip side of that is to utilize that method that we just talked about. So if the market pulls back, doesn't mean it will. If the market pulls back, we could be looking for opportunities off of the tops of those previous lower highs and stop losses at the previous lower low. So that's one way we can be looking there. Over here on crude's been in one crazy rally We're back up to the 25.50 area up here. 25.50. We've been making a run at that yesterday, and now today we've made a run up here, and we'll see what happens with it as we get further into the session. Obviously, oil has been rallying on the hopes that the country's opening back up and we're going to have more oil and gas utilized. So we'll see if this rally continues, but right now 4 hours long and 30 minutes long, so we'd be looking for long opportunities. So if we break these highs and above 29.50, 29.60 here, we could look to continue long from there. Or of course, if it pulls back and starts to pull back on us, then we could look for bounces down here off of this 29.60 area. Look for bounce opportunities, even 24.60 area, 24.80 area down here, looking at potential bounce opportunities. Or again, utilizing that method of watching and entering your entry point at the top of that previous lower high, or previous and stop loss at the previous lower low. So we can see how that plays out. Gold, because the biases are mixed, not interested in what's happening with gold. Over here on the crypto side of things, we had a big sell-off prior to yesterday's Bitcoin halving. The Bitcoin halving happened. It's almost like a tongue twister, but didn't really do anything. Totally lackluster. It did not have the impact that it has had previously, and that could be that we're just in a bit of what's called a quote crypto winter, in that it hasn't been as hot as it typically has been in the past. There's not quite as much news around it. Also, with other markets being down, there being so much turmoil and unrest in other markets, it just simply could be that the attention's not on here. So, crypto, big sell-off coming into yesterday. On Bitcoin, the 4-hour trend is still long. However, we are starting to see some consolidation here, so that might be rolling over for us. On Ethereum, we have rolled over. So Ethereum, the 4-hour bias is now short. So we have a short bias in ETH. So we'd be looking for shorting opportunities, and that would mean either selling on a pullback. So if this pulls back to this 192 area, we could look to sell off of that. Or if it breaks lower than 186, 187. If it breaks lower than 187, we could look to sell from that area to take advantage of potential downward movement based on that 4-hour bias. Bitcoin, though, is still a buy, so they're mixed. Bitcoin and ETH are mixed. A couple more downward bars on Bitcoin, and we could be looking for that to go short again from there. So we'll see what happens. So anyway, that's it for now. That's it for me. If you have any questions, please let me know. The bottom line for all of this is just you've got to have a solid system that you can execute the same way every time. It needs to be based on something quantifiable, not based on your emotion or what you think should happen, because what you think should happen or what I think should happen is totally irrelevant to the market. We've got to have a quantifiable system with measures of when we get in, when we get out, when we take action. And then we've got to have the mindset to stick to that. So quantifiable system, good money management, mindset. That's what it's all about. Everything else falls into place. I think you'll struggle most with mindset, but you've got to get the system first so that your mind can buy into it. So it's got to be your system. So utilizing some things that we've talked about here, you should be able to create a solid system. All right.